Welcome to our annual Capital Insight Partners Market and Economic Outlook. We are very excited to be celebrating 15 years in business. Back in 2008, Steve Nelson and I left our former firm in the midst of a monsoon storm. It was, of course, 2008 during the global financial crisis also, so it was a pretty ominous time to be starting a business. Despite that, we were able to take clients through the market recovery that started in 2009. We also helped navigate extreme volatility in the markets in 2020 because of COVID and the pandemic. In addition, we have acquired a couple firms along the way. So back in 2016, we acquired Sequoia Financial Advisors, and then in 2020, we acquired Foothills Asset Management. By combining these firms, we've been able to have greater efficiencies, retain great staff, and keep our fees consistent despite inflation. We've been able to help clients go from working years to retirement years successfully, and we've also passed assets from one generation to another generation. It's been a rewarding 15 years, and we're so grateful that you've been able to be a part of this journey with us. We're especially happy for all of those clients that started with us way back in the beginning. Thank you to all. Now I'd like to transition it over to our investment team that will take you through a recap of 2023 and tell you what they see for 2024 and the future. Thank you.
Thank you, Susan, and thank all of you for joining us today. My name's Steve Mahan. I'm a senior portfolio manager with the firm, and I'm joined here by three members of our investment team. So Sarah LeClaire, senior portfolio manager, our co-founder and CEO, Steve Nelson, and then our chief investment officer, Craig McRory. We're going to have a discussion that covers a wide range of topics today. We'll talk a lot about some of the questions that we get most often from our clients. The team here will take you through some of the risks they've got their eye on moving into next year, and we'll also talk about some of the opportunities that they're excited about. Now, before we get into that, though, I think it makes some sense to just recap 2023, and we'll walk through the performance of stocks, bonds, and cash. So let's go ahead and start with stocks. Now, if you look at the chart here on the screen, you focus on that middle gray line. That's the performance of the S&P 500, so a broad index of U.S. large cap stocks through about the middle of November. And you'll see there, up about 19%. That's a very strong year for the overall index. We're filming this on December 15th, 2023, and we've had a good couple of weeks. Now that same index is up about 24%. But what I want you to notice, if you look at the slide here, is that the participation was very narrow. So the market was led by just a few names. Those names are represented by that dark blue line. It's the largest 7 companies in the S&P 500, names you know, like Apple, Microsoft, NVIDIA, and you can see they've significantly outperformed the broader market. When you look at that light blue line there at the bottom, that represents the performance of the other 493 companies in that index, so much more muted. And I think that's why, despite a year where you've had a stock market that's really done well by historical standards, most people don't feel like it's done very well. And I think that's because while the index has done great, the average stock really hasn't. Moving into bond markets, 2023 was the second most volatile year of the last 2 decades when it comes to the performance of bonds. But we've had a fierce rally here over the last month and a half or so. And now, year to date, core bonds have given investors about a 5% return, which is pretty good historically. So again, hasn't felt like a great year, but actually it looks like we're going to shape up to be okay. I think the one place that maybe has felt good is to be invested in cash. You know, we saw rising rates take the interest rates paid on money market funds to places we haven't seen in decades. You know, they're paying north of 5% today, and that's attracted a record amount of capital. Today, there's about $5.7 trillion invested in money market funds. So overall, 2023 was a pretty good year, actually, for investors, but I don't think it necessarily felt that way for a lot of people. And I think that would be a surprise, because if you said at the beginning of the year, we're going to go through a year where you've got recession fears, where you've got multiple wars, where you've got a banking crisis, and oh, by the way, mortgage rates will be over 7%, I think most of us would be really shocked and surprised that the stock market is up north of 20. So I think that's a pretty good place to start our discussion. I'd like to open it up to you guys, and we'll start with you, Steve. What did you find surprising in 2023?
Well, to build on what you said, the consumer was strong. The consumer held in there all year long, despite all the things that you mentioned being thrown at them. So even as we finish the year, it appears that the consumer is still generally okay. There are some cracks potentially out there, but generally the consumer was my big surprise.
Yeah, interesting. Craig, how about you?
Yeah, I think the biggest surprise, the biggest surprise from my side was the frequency in which people were trying to predict the Fed reducing interest rates. So beginning the year very early in Q1 and Q2, there were some large vocal voices out there predicting that the Fed would have to reduce rates because of a slowing economy and consumer spending. And we just frankly didn't see that. Transparency from our side, our view was that we felt that the Fed was very clear on the fact that they would be maintaining a high level of interest rates until such time as they saw clear evidence that the economy was slowing. During the year in Q1, the markets fell 7%, in the middle part of the year, there was a rally of about 20, but then kind of in Q3, there was another pullback of around 10%. And so it's very normal for the markets to have a pullback like that during the year, but it was really based solely off of the speculation that the Fed was going to be reducing rates, and that just never transpired.
Yeah, it's funny that if you go back, what I heard a lot at the start of the year was, 2022 is all about rates, and now 2023 is going to be all about a recession, and it seems it turned out that 2023 is about rates.
That's right.
Again.
Yep.
Sarah, how about you? What surprised you this year?
Yeah, I'll echo some of the same message. What surprised me was just how good the year ended up being, given how unnerving and unsettling it felt at multiple times throughout the year. I mean, we felt it at different points, and we know by having conversations with our clients that it was a widespread feeling against them too. If we look back to the beginning of 2023, we had estimated that a total return for a balanced portfolio, which is going to be about 60% stocks and 40% bonds, would be in the range of about 5% total return. And frankly, most of that coming from the bond portfolio. Fast forward to today, those same portfolios are up about 12%, which is great. It's just been really amazing to see how well the stock market has held up, given the backdrop of the interest rate environment that we've been facing.
Gotcha. Well, that's a little bit of a recap of 2023. Let's look forward now to 2024. So maybe, Steve, we'll start it off with you. Can you give us some of your thoughts on the current economic environment?
Well, I have a little bit of hope, but as you look back to 2023 and the leading economic indicators, you can see that the chart, just as in past recessions, which are in the shaded areas, that chart of the leading economic indicators just kept dropping and dropping and dropping. It was like 19 consecutive months of declines. But I'm a little hopeful because at the bottom, you begin to see potentially a bottom and then a little bit of an uptick. Obviously, the stock market seems to be finishing the year very strongly, even though we're in mid-December today. It looks like we're going to finish the year very strongly here in the fourth quarter. That's a good sign. It's one of the elements of the leading economic indicators. So maybe we've hit bottom and we're going to start climbing out, and you'll see that GDP line at the top continue to go higher. We'll have to see what the data shows, but at the moment, after a really tough environment for the LEIs, the leading economic indicators in 2023, things look a little brighter heading into the new year.
Okay, that's good news. I think you mentioned that chart, and every time we've seen the leading indicators fall like this, you've had a recession, but we didn't see that in 2023.
Not yet.
Not yet. Not yet. Yeah. But I think the big thing that kept that from happening, and you mentioned at the onset, this engine that kept us out of a recession was the U.S. consumer.
Yeah.
So the outlook for the consumer is really important moving forward. Craig, can you give us maybe your thoughts on the shape of the consumer today?
Yeah, one way we look at this is through the size and the health of the economy through what's called the gross domestic product, or the GDP. And here in the United States, as we can see from this visual, is the dark shaded blue there is of the economy and the goods and services that are produced here in the U.S., about 2/3 of that is the consumer spending, right? So that really that value comes from the consumer and their activity. And as you mentioned, the surprise really for us was the strength of that consumer during 2023. It really held up, and we saw GDP numbers actually accelerating throughout the year, higher than what we would have anticipated. And so that was actually a really interesting part of how this composition goes. From our view, I think that this is an area that's positive, but also at the same point, we're starting to see some elements where this is maybe changing a little bit.
Okay, well, on that, okay, changing a little bit, what do you mean? Expand on that a little bit.
Yeah, so I think when it comes to the health of the consumer and what's held up so well kind of post the pandemic, they had excess savings coming out of the pandemic, and really there was some unspent cash, whether it's supply and demand imbalances, different things. Those have started to normalize here over the last 12 months. And a sign that we look at is, well, how much savings do they have and where is that spending going? The other side of that is the delinquency rates. So they overspending in certain cases. And so on this visual here, you can see we're looking at delinquency rates of automotive loans, of credit card revolving debt, and also within student loan repayments. The student loan repayments, they were deferred through the government for a couple of years, so that number's been kind of stagnant and flat. There's not a lot of updates there over the last couple of months since they've been reinstated. What you can see here with auto loans and credit card debt is those numbers have started to rise in 2023. Right now, they're about an average of where they would be historically if you exclude the financial crisis in the early 2000s. But the concern that we have is that that number never kind of stops at the average. It may tend to drift up before it kind of normalizes again and settles. And so that would indicate that there's maybe some potential weakness coming in the consumer itself. One thing that we've also looked at here is kind of reinstituting something from a couple decades ago. Buy now, pay later is a new way in which people can buy goods and services. And there's been a 20% year over year increase in that type of platform. And so, Steve, I know you heard something recently that indicated just this most recent Black Friday that about 40% of the goods purchased on that day were using buy now, pay later. We would have to assume that over the next year, some of that will result in default, and that would basically be similar to a credit card default, and so therefore that actual delinquency would be elevated more than it is today.
Gotcha. Okay, so safe to say, I mean, still strong, but cracks under the surface starting to develop that are probably worth watching as we move into this year.
Yeah. And I'll add too, on the employment landscape, the job openings have changed. You know, last year when we got together, that was about 2 job openings for every 1 employee. That number's now 1.5.
Oh, wow.
And so you're seeing some of that weakness kind of coming into the market and the economy as well.
Things sort of slowing down. Okay. Well, thank you for that, Craig. I can tell you what's impacted this consumer a lot over the last 2 years has been inflation. Sarah, can you give us maybe how we see inflation and where we might see it going?
Yes. Well, certainly inflation is one of those big risks that we're really focusing on in the next 12 months or so. You know, the Fed has an average target inflation rate of 2%. And if you think about an average line, you have some data points that are above the line, and then you need some data points below the line in order to draw out that average. And I think the image here that we'll present does a good job depicting this over time. We've experienced periods where inflation has overshot to the upside, and it's followed by overshooting to the downside. Now, most recently, we saw a really swift uptick in inflation. And while it has started to come back meaningfully, it's still lingering above that 2% average rate. So the Fed really has one of two options. They can either stay steadfast on achieving that 2% average inflation rate, which would mean that naturally we need to see some data points below that to bring us down to the average, or they can pivot and start to shift their thinking to a higher rate, which is probably pretty unlikely. Now, for the Fed to stay anchored on a 2% target, it means continuing to put pressure on the economy, which puts pressure on the consumer and also impacts the employment environment, which is another key factor that they're watching too.
Okay.
Yeah, and I'll add to that briefly as well, is historically when you look at when the Fed begins to cut rates, they traditionally do not cut rates when inflation is above 2%. And unemployment is below 4%. Wow. So their job is still not done.
Okay, yeah. So maybe we're seeing inflation come down, but maybe it settles a little higher than what we're used to in the past, and that could complicate the job for the Fed a little bit moving forward. Okay, yeah. Well, the other big thing that I hear a lot in terms of meeting with clients, and it makes sense, we're moving into an election in 2024. I think that's starting to be top of mind for a lot of people. Steve, I'd like to ask you, how might the election maybe impact markets?
Well, generally it's a positive for the capital markets, but it's painful for all of us as Americans to have to endure the ads that will, just relentlessly come at us over the next year. But for the capital markets, election years are typically pretty good years. You'll see in this chart, the bottom line is the election years. The top line is the non-election years. Now, from beginning to end, it's typically a good year in an election year. That is particularly the case in the fourth year of an incumbent who is running for re-election. We've got that at least currently, and you've got you've got a situation where historically that year, an election year, and then with the incumbent, is really a pretty good market environment, but it's not evenly distributed throughout the 12 months. You'll see in the chart that the market often struggles the first 6 months or so. It's not until you get out closer to the fall, when you begin to get some clarity on the election, that the capital market begins to run. And that's kind of in keeping with our view this year, is we would expect, just like we saw in August, September, October of 2023, the market may have some tough months. So investors should be prepared for some rocky months coming up. At the same time, though, don't lose sight of the fact that from beginning to end, this next election year should be a good year for the markets.
Yeah, okay. You want to kind of look through the noise that's naturally going to come with this, right, and kind of move past it, because ultimately the stock market's based on the economy and businesses rather than political parties.
Right.
Sarah, let me ask you, are there any places, maybe any industries, any parts of the market that the election year maybe offers up some opportunities for?
Yeah, well, that noise costs money, right? And if we think about ads, we're about to be inundated with them. And regardless of party affiliation, all parties and advocacy groups are going to be spending money on political ads during this election cycle. It's estimated that this year, the advertising spend through the entire cycle is going to be roughly $16 billion. Again, that's $16 billion. That's a 30% increase, just over, of what the last election cycle in 2020 experienced. And if we look under the hood a little bit, the majority of those advertising spend dollars is actually allocated towards local broadcast TV. So a company like Comcast, through their media outlets, stands to benefit in an environment where we have the increased spending around an election cycle. And also the social media companies too, through their advertising revenue capture.
Interesting. All right. Always opportunities, I guess. We've talked a lot at a very high level about some very macro kind of topics. I'd like to transition now and talk a little bit more about markets, how these macro themes kind of play into what we expect for markets moving forward. So Craig, maybe I'll start with you. Give us the way you see the stock market currently, and maybe how you're thinking about it going into this year.
Yeah, our firm's view is generally we're optimistic here for what comes ahead. One of the important things to remember at this point is there's a difference between the economy and the market. And so while they both have cycles, they actually are operating under different timelines. The stock market normally operates around a 6 month to 1 year in advance of what the economy is actually doing. So as analysts, we're always trying to look forward and say, well, what's coming next? And what do we want to be thinking about, whether it's goods or bads, in the economy that will transit into the companies that we're investing in. So on the visual side that we have here, you can see in the green and red shaded areas, that's the business cycle of the economy. And so as we would expect, there's periods of expansion and contraction, and then that's the cycle that you see. Mm-hmm. The stock market follows a very similar path, only it's advanced about 6 months to a year before that actually happens. And so as today we're talking about some of the risks in the economy and the potential slowdowns in the consumer and the employment landscape, the market's already looking forward. And so they're saying we're digesting that and looking ahead. And so I think what we may be experiencing now at the end of 2023 with the markets kind of having this nice little run up, we may be starting to see signs that that's actually picking up and that we're viewing the economy slowing down, but the markets are already looking beyond that.
Okay, so a lot of the bad news kind of priced in already. Yeah, makes sense. Mm-hmm. Sarah, can you speak to a little bit about how are we positioning stock portfolios today?
Yeah. So, it's interesting. As I look around to the four of us, we have some pretty varying perspectives on what may transpire over the markets, say, the next 6 to 12 months. But what we all agree on is that we're optimistic about what is beyond that. And when we think about taking all of our perspectives together and looking at the portfolio through our each individual lenses, we're able to craft and manage a basket of securities that takes the potential range of outcomes from maybe a much wider place to something that's narrower, something that we can navigate the path forward with. One thing that we all agree that we got right in an action that we took was reducing our real estate exposure right at the beginning of the interest rate hike cycle. And real estate's an interesting area. It's not just the commercial real estate like we're hearing a lot about in the news flow lately. It also encompasses other areas like residential homes, storage units, healthcare buildings, and others. When we look broadly across the sector, this is a very interest rate sensitive area of the market. And so by meaningfully reducing our exposure to real estate early on, before that sharp uptick in the interest rate cycle, was a decision that we're proud of that we had taken in the portfolio. At the top of our conversation today, you highlighted the strength in the tech sector primarily, and there's other areas too that have really seen an uptick in performance coming out of their trough. And Steve, you mentioned continuing to see this rolling recession move through the markets. Healthcare, industrials, utilities, and even those consumer staple businesses, which are going to be more of your necessities, your necessary needs, like your food companies, home or personal care products. They've all seen their own stresses throughout the year, and we're starting to see signs that they're moving past their trough point too. Healthcare has been an interesting one. There have been a few companies who have done really well, and those are the ones who have exposure to more of the obesity drugs. But if you look more broadly to all of the other companies, they've struggled a bit over the year. In the industrial sector, there's some opportunity ahead. If you think about the Infrastructure and CHIPS Act that were recently passed, only about half of those funds have been awarded and allocated. So as that money continues to work its way through, companies involved in the construction of those products, whether they're the picks and shovels or the materials that go into them or the companies that manage them, they stand to benefit going forward as well. So this gives us a way that we can lean in to certain areas and pockets of the market to try to capture some of that opportunity that's still ahead.
Okay, so you got a really broad, kind of diverse opportunities that you can't think about like the stock market. It's more the market of stocks. Right? It's kind of what you're looking at. Can you give us an example of maybe one of those stocks or something that we're excited about moving forward?
Yeah, I heard this phrase recently relating to real estate, the residential side, that I thought was kind of interesting and relates to our world too. It was you marry the house and you date the rate, meaning you date the interest rate on your mortgage. And when you think about long-term investing like we do, you can almost translate that into our world as well, where we marry the company and we date the volatility. And the volatility meaning the stock movements up and down, the price movements up and down. And we've certainly experienced a bit of that over the last several years. But what we've stayed consistent in doing is being invested in quality companies that we believe in over the long run. Casey's General Stores is a great example of this. They're a Midwest convenience store that's actually the 5th largest pizza joint in the US, if you can believe that. They have a large presence in rural towns with populations less than 5,000 people. So their in-store food and drink offerings actually makes them like a community gathering place, more so than just being an operator of a convenience store or gas station. So they really have a presence in the communities that they operate in. Their management teams have a proven record of meeting their strategic plans. They're not nearly as levered or have as much debt as other companies. And when we look back on their performance compared to the S&P, which would be the broader market, and even their peers within consumer staples, they year in and year out seem to deliver on their results. So while it might not be a company that you hear about often in the news, and you may never have heard of them if you're not from the Midwest or have traveled through there, it is a company that we believe in because they've delivered on their results consistently.
Interesting. So high quality companies that execute at a high level, those are out there. Interesting. That's kind of the stock side of things. We have a lot of investors that have significant exposure to bonds. I'd like to kind of move to that part of the portfolio. Give us a sense for how we're positioning bond portfolios today, and where do we maybe see that going?
Good question. So, last year we stated that bonds are back. And while it certainly has been a volatile year from a yield perspective, bonds have showed us that they've earned the position in portfolios again. If I look back on our firm's history, this arguably was probably the most active that we've been from repositioning and trading within the bond sleeve in our firm's history, and with good purpose. Last year we talked about incorporating some high yield into the portfolio. Mid-year, we took a look at that and we said, that allocation has given us what we've been looking for. So we use that opportunity to pivot and to start really drawing out that length of time until maturity in the bonds within the portfolio. I'd like to bring up a good chart here about where yields are right now. When we look all the way back to 1870, a yield range on fixed income or bonds within 3 to 6% is about an average rate. Now, that's not something we've seen in the last decade or two, so it feels unnormal to us, but it is average when you look over the long term. So not only have we been lengthening out that time of maturity in our bonds, but in clients' accounts where it's appropriate, given their investment objective, we've also been adding to the bond weight within portfolios. So you've seen both that weight of the bonds increase as well as the maturity to start taking advantage of the fact that yields are in a much more normalized
Gotcha.
band.
Okay, so if yields are higher than they've been kind of normal throughout history, and you want to lock them in for longer periods, if that's
Precisely.
what they're. Okay. And just about every meeting that I've had this year, investors have brought up cash and what to do with it, right? I mean, rates on money market funds are attractive, up around 5.25%. Craig, I'd like to ask you, can you tell us what you think investors or how investors should be thinking about their excess cash holdings?
Yeah, 2023 brought back the idea that it's a saver's market again. And I know several of our clients, as well as market participants, we're eagerly awaiting this for a very long period of time. And we haven't seen this in over a decade, where your cash savings actually is paying you a decent level of interest. And as you mentioned, Steve, north of 5% today. And that, from a risk reward spectrum, 5% is a pretty good kind of return for your money. Now, when we look at this from a historical perspective and also looking forward here, is when an economy starts to slow down and the Fed starts to maybe get to the top of their interest rate hiking cycle, the next logical place for them to go is down, right? So when we look at this on this image here that you can see in the gray shaded area, this is once the Fed reaches their maximum as far as raising interest rates, their hiking cycle is now done. The months following that, this is the return that you see in cash. So in that gray shaded area, 5% towards the end after about a year or so, that's not a bad return, right? But where you see above that is a spaghetti number of lines, right? You see U.S. stocks, international stocks, bonds, as well as a combination of stocks and bonds in more of a balanced portfolio. Point being, all of those are above the cash return. Yeah. So while that 5% looks good today, fast forward a year, 2, 5 years down the road, you may look back at that and go, wow, I really gave up something here, given if I have excess cash. Mm-hmm. And so we've had a lot of conversations with clients about cash that they have above and beyond what they need to meet their immediate needs and their emergency funds. And so we're recommending that while there's this window of time where the Fed is paused, that we start to put a plan together to really get that cash to work. Depending on your investment objective, it can be in stocks, it can be in bonds, or it can be in a combination of the two. But what we normally see is that in an interest rate hiking cycle, interest rates on your money markets tend to go up very slowly. Mm-hmm. So we think about that going up the stairs. And then last year with just how quick the Fed raised interest rates, it was really the escalator up. But once we reach that top point, when they start to think and we start to feel that interest rates are going to come down because the economy starts to slow, that ride down is very quick. So we oftentimes think about it, it's the stairs or escalator up, but the elevator down. And we're trying to recommend to clients is, let's put that plan in place now while we have an opportunity so we don't have to watch that elevator go down so quickly.
Yeah, okay, gotcha. So when rates are rising quickly, that's good for money market funds because you're picking it up fast, but yep. When it goes down, they're picking that up fast too, and things like stocks and bonds tend to rise when that's happening.
That's right, yep.
Good. Well, thank all three of you. This was, I know we covered a lot and you guys were very, very helpful. I'd like to just give maybe some key takeaways from the team, as we start to wind things down here. And I think first and foremost, the U.S. consumer is pretty strong, like in a good place, but showing some cracks underneath the surface. and we're starting to see the economy start to slow down. So I think investors should be prepared for that. However, because that might mean that the Fed cuts, that's not necessarily a bad thing for markets, and you may see a pretty positive, but albeit volatile year in 2024. That's what we're expecting. We also think inflation's coming down, might settle a little bit higher, and we think the first half of this year is probably a great time to really start taking a look at that any excess cash that you have and coming up with a plan of how you want to get that into the markets and maybe get back to your target allocation. If you have any questions about anything that we've covered today, please reach out to your advisor team. I would like to say thank you to the panel once again, and I will turn it over to Steve Nelson to go ahead and close us out.
Great. Thank you, Steve. And thank you to all of you. I'd like to echo Susan's words on behalf of the partners, the portfolio managers, and all the team at Capital Insight Partners. It's just been a real privilege and joy to have the last 15 years to serve you and try and help navigate through all these very changing markets that are always evolving and meandering through the marketplace. But it is a true privilege that you give us to take care of and to help steward your assets. And for the last 15 years of that, we are deeply grateful, and we very much look forward to the year to come and hopefully 15 years beyond that as well. Thank you.